So, welcome to this webinar on ESOP Trusts, why, when, and how. We are really pleased to bring this to you. There are a lot of questions which are asked on this subject, and at ESOP Direct, we thought it would be a right step to have a webinar on this topic to understand the nuances. And we'll just wait for a minute or two to give a buffer to people who are joining. But before that, I would like to take this opportunity to introduce our speaker, Mr. Uma Shankar Acharya. He heads the consulting function from the legal background and has been in the subject matter for more than 12 years. And he would be taking us through or educating us on the provisions around ESOP trust, how one should look at ESOP trust when you talk about implementing a long-term incentive plan, and who should look at ESOP trust as a option as in comparison to direct route. So, Uma, welcome. Good evening to you as well. We'll just wait for a minute and then I think we'll be good to start. 4:02, 4:03, we can start. I'm sure this webinar will be pulled a bit longer, so we have buffered some extra time. But over to you, Uma. To all
Thank
the
you, Abhishek.
participants, your camera and mic access is limited, but you can write your questions, and at the end of the session, it would be my responsibility to, raise those questions with Uma and try to provide a quick feedback on your questions. And if at all they are unanswered, you can definitely write an email, and we'll be more than happy to revert or get on a call with you and explain the intricacies to you in detail. So over to you, Uma. Thank you, everyone, for joining.
Thank you, Abhishek, for introducing me. Hello, everybody. Good evening. After the conference, this is probably the first webinar we are taking up. Even though we have planned for many webinars, particularly the selection criteria for topic has been the kind of queries we used to get from companies. Whether client companies or say companies which are prospects for us or the companies in general. So out of many topics, we saw that there are frequent questions coming from the ESOP trust point of view. So we thought why not to take up this ESOP trust topic is the first webinar after the conference. I'm referring to our conference which we held in December. So we can start. Just a moment.
Yeah, Uma, we can start.
My screen is visible to you?
Yes,
as well?
Uma, it is visible.
Okay. Okay, so we can start. Should we wait for 1 minute or so, couple of seconds?
Yeah, I mean, it's 4:03, Uma.
Okay.
While we can start with a background about trust, right? People are yet joining, but we can definitely start. Otherwise, we may run out of time.
Yeah. So as I said, everyone, that we used to get the queries from many companies. So here we see there are there are three kinds of companies from whom we used to get queries. The companies are the first kind of companies are who have an ESOP scheme as well as ESOP trust, and they have certain queries as to the operations of ESOP trust, as to whether they can do this thing or that thing. This kind of queries used to come from those kind of companies. Now, second kind of companies who used to have questions, who used to have apprehension, is that a company having an ESOP scheme, but they don't have an ESOP trust. So for the time being, they are following direct route. That is what is called as a company route without any trust. But for whatever reason, they are examining whether they should have an ESOP trust to bring in more efficiency, in terms of administrative convenience or in terms of minimizing certain risks, etc. So these are the considerations. Talking about yet third kind of companies those companies are at the stage of framing an ESOP scheme. They don't have an ESOP scheme, but very soon they would be coming up with an ESOP scheme. So while structuring the ESOP scheme, they are considering whether they should implement the ESOP scheme with the trust route or not. So these are the categories of companies from whom many questions used to come, but the questions are really common irrespective of the type of company or the stage of implementation of ESOPs in those companies. So when we talk about ESOP trust or trust, etc., so why the really, I mean, why the stress is on the trust form of organization? Why we are talking of a trust at all? So when we talk about ESOP trust, we necessarily talk about an ESOP scheme, because without an ESOP scheme, here ESOP scheme, I mean every kind of equity-based compensation scheme, whether I'm talking about a plain employee stock option or stock appreciation right scheme or restricted stock unit or employee stock purchase scheme or what is called ESPP, employee stock purchase plan. Just for a quick understanding and for simplicity, I'm using the word ESOP for ESOP and every other kind of ESOPs variants. So now for ESOP trust, the context is that there must be an ESOP scheme, that means an equity-based scheme. And when we talk about an equity-based scheme, we are essentially talking about equity sets. And when we talk about equity sets, of course, as we know, equity sets are very well regulated, and movement of ESOP equity sets, how to acquire, how to hold, how to dispose of every aspect of equity share. On every aspect of equity share, there is a provision. So for that reason, the Companies Act and the SEBI regulations, particularly if I talk about ESOPs of listed companies, I'll be talking about the SEBI SBB regulation. I'm getting some noise. So, Abhishek, can you see if you can mute? Yeah. So I was just giving you a background of the ESOP trust, and in that context, I was bringing the role of equity sets, and in that context, I was also bringing the role of Companies Act and SEBI regulations. So if you see the basic foundation of Companies Act, it states that any company, I'm talking about any kind of company, whether it is a startup company, listed company, or unlisted company, in India, what is not permitted is that under the Companies Act, a company is not allowed to acquire, hold, and transact in its own sets. So company itself cannot do this transaction like acquire, hold, or make a holding of its own sets and transact in its own sets. That is not allowed. The case is same even for listed companies where SEBI in its share-based employee benefit regulation, what we call in short SEBI SBB regulation, it very clearly states that a company cannot acquire, hold, and transact in its own sets. However, both these laws have given the liberty to the companies to do so only through a trust. So now the conclusion here is that if a company, for the purpose of its ESOP scheme, wishes to acquire, hold, transact, or otherwise deal in equity shares, it must be through a trust, and it should not be by way of any other kind of business organizations. What we know, like a company cannot handle its equity shares for the purpose of ESOP by way of a partnership form or through any other company or by way of society form of organizations. That's why the relevance is set. I mean, the context is set from the law point of view that if a company wishes to acquire, hold, and transact, only ESOP trust or a trust structure must be there. So what kind of trust is this? When we talk about ESOP trust or any kind of say trust, what is the kind of trust we are talking about? So if you see the very basic nature of this trust is that it must be an employee welfare or employee benefit trust, and you must be, or most of you must be aware, or may have come across with the words like EWT, what is called Employee Welfare Trust, EBT also. Some of us also use the word EBT, Employee Benefit Trust, and many uh, uh, companies use the term ESOP Trust. So here we are discussing ESOP Trust. All three are synonymous, almost same. Uh, so these trusts are based on the principles of Indian Trust Act. So Indian Trust Act is blended into whatever is the requirement of the Companies Act. And in case of a listed company, what is the requirement of SEBI, SBEB regulation? All three things are blended: Companies Act, SEBI, and Indian Trust Act. That's how a trust deed comes out. This trust can undertake as core objective. What is necessary is that the if you are talking about the ESOP trust, that ESOP trust must have the core objective of any employee welfare activity, including ESOP implementation, or only ESOP implementation. In any case, if ESOP implementation must be one of the core objectives. That's how, and that's why we can call it, yes, this is a trust or an ESOP trust which is capable of doing ESOP transactions. For a listed company, there is a specific requirement for a listed company that it must be an irrevocable trust. Irrevocable trust means a trust uh, which upon liquidation or dissolution, the residual money net of any liabilities cannot be taken back by the company. So if the company settles the trust on dissolution or liquidation, the residual money should be used only for employee benefit. That is the concept of irrevocable trust. Now, another kind of feature of this trust is that it is considered as a private trust and not a public trust. And why I have just mentioned this deliberately, because there is a kind of myth uh, uh, with some of us that if a trust is found by a listed company, whether that would amount to a public trust. So public trust criteria is entirely different. Public trust means that the trust where beneficiaries are uncountable number of general public. Here, if I'm talking about a listed company, or even I can talk about a PSU, public sector undertaking company, or a government company, if that company also forms an ESOP trust, that will amount to a private trust. Private trust for the reason that only selected few individuals or employees would be eligible to participate to the benefit of the ESOP scheme or benefit of the ESOP trust. That's why it is private trust. And how it is creating a difference? If a question is asked, why why it is important to classify private trust or public trust? Because in case of a private trust, the demat account is opened in the joint names of the trustees. So from regulation point of view, a private trust is never seen as a full-fledged individual or entity, unlike a public trust. However, in the income tax, that treatment is different. We will separately discuss that. But the general nature is that it is a private trust. Now, as the topic, the topic is stated as why, when, and what about the ESOP trust. The question comes, why an ESOP trust? Or when the ESOP trust should be considered seriously, whether company should go for an ESOP trust or not. Uh, First of all, there are three situations we have just articulated on. The very first, foremost, unavoidable situation is that, first of all, as a company, whenever the company is planning for an ESOP scheme, company has to see what is the basis of source of shares. Because whenever a company plans to implement an ESOP scheme, there are many questions on which deliberations happen. What is the source of shares? What shall be the intended coverage of employees? Whether foreign employees would be covered? What is the percentage of equity that shall be kept as a reserve? Uh, Whether cashless exercise facility shall be given to the employees or not. So there are many questions actually deliberated at the time when ESOP schemes will be structured, and at that stage itself, one would get answers whether an ESOP trust would be required or not, or ESOP trust would be required on a mandatory basis or not. So first of all, as per law, uh, whether a trust creation is mandatory and optional, the answer has been given in, say, Companies Act and SEBI ESOP regulation, what we call SEBI SBV regulation. So the very basic criteria is that whenever secondary sets are contemplated. So as we know, I mean, an ESOP scheme can be implemented using either secondary sets or primary sets. Secondary sets are those sets which are already issued, and those sets can be procured by the company through any SPV. Here in this case, it is ESOP Trust. Uh, that procurement will be by way of gift, or those shares can be sold by the shareholders, willing shareholders, or the trust can acquire from the stock exchange. All these are secondary shares because those shares were already issued. So in this case, trust route is mandatory. So there is no choice whether you have some other, you know, whether you will go for a cashless exercise facility or not, whether you have large coverage of employees or not. In case of secondary shares, the blind thing is that, or as a thumb rule, you have to go for the trust route. In case I'm talking about the second source of shares, which is often, I mean, majority companies used to do, is primary shares. Primary shares means, say, some 5% or 7% of the paid up capital is reserved for ESOP scheme. And it is thought that as and when employees would exercise, company will issue those shares. Or at any point in time, even prior to exercise, company will issue those shares. So I'm talking about issue of shares by the company. Those are called primary shares. In that case, the law states that in case of primary shares, the company shall have a choice of either moving through direct route or trust route. So there is a choice available. So here one question arises: if a company says that uh, we are going with primary sets and we have a choice of direct route or trust route, whether we can have both the routes for one scheme. So the answer is both routes are not available simultaneously. It cannot be applied. Both routes cannot be applied. However, what is required is that companies should go with only one route. In optional cases, only one route, either direct route or trust route. And in case afterwards, in midway, if it is thought that the route must be changed, so route can be changed. If a company goes with a trust route to start with, and afterwards it feels that it should convert that trust route into direct route, that is possible for any kind of companies, including listed companies. Even SEBI has given this liberty, and vice versa. If it is a direct route case, and if it is felt that trust route is necessary for whatever reason for getting more efficiency, that is also possible. Now the desirable situations. So desirable situations, particularly, these are the choices available for a company where trust route is optional. So in that situation, companies should think of whether these desirable situations exist for which companies should consider having an ESOP trust or not. So the first pointer is that if there is a large employee coverage, if there is a large employee coverage uh, coupled with, say, when we talk about large employee coverage, so there are high chances that there may be frequent exercises. If I talk about an ESOP ecosystem where 1,000 employees have been granted ESOPs, and people used to come to the company, the ESOP administrator, every 2-3 days for exercising ESOPs. Or kind of say every day there are ESOP exercises. So that kind of situation, maybe there are high chances. And there is another pointer is that in case the share price of the company uh, uh, goes through high volatility. I mean, every 2-3 days or 5 days, we see say 5-10% is up and down in the prices. Whether in that situation, ESOP trust would be helpful. So if you see, in case of what happens, in case of exercise is that after every exercise, in case of particularly primary sets where ESOP trust setup is optional. In case of in case assuming that there is no trust route, what will happen is that in that case, after every exercise, there shall be request for approval to the board for allotment of shares. So now if exercise would happen every day or exercise would be happening every 3 days or every week, whether it is possible for the company to approach the board or board's authorized committee to uh, to to get an approval for allotment of shares, that is practically a kind of impossible, that a company cannot approach a board every 2-3 days or every week for getting share allotment approval. That's why it is thought that why not to create a platform where the shares can be parked, so that as and when exercise applications will be filed, the trust itself, without going to the board, will just clear or transfer the shares from its window. This is number one reason. Number two reason that relates to price volatility. What happens is that, again, assuming there is no ESOP trust and the employee has exercised today, today is 2nd of February, and in allotment case, without a trust route, what happens is that generally companies take around say 4 to 6 weeks time to get the approval and to credit the shares, allot the shares as well as credit the shares into the demat account of the employee. So what will happen is that on 2nd of February today, I saw as an employee, my company share price is 200 and my exercise price is say whatever is the price, say 50 rupees or 100 rupees. I'm in very good in money and I have exercised today, hoping that I will get money. But what would happen is that I will be getting my shares into my demat account uh, on 10th of March, when the price could be anything. That could be maybe 80 rupees, that could be 300 rupees, anything. But what would happen if the price would be really below, maybe below the exercise price? So anything can happen, because if the price is volatile, allotment process without a trust route generally takes months time. This is the thumb rule I'm telling. Few companies may take 15 days time and few companies used to take even 45 days. I'm just taking a middle ground. So this is really very helpful for tackling where the price is hugely volatile, and this may be relevant for listed companies because I'm talking about price volatility. Generally, this never happens, or this is never observable in an unlisted scenario. And as far as time duration, the turnaround time for transfer of shares from trust to employees demat account is very less, maybe around say 7 days time or so, around 7 days time, vis-a-vis 1 month's time in allotment case. So there is an efficiency. The another point is that freezing of shareholding pattern in advance. We have seen that this is particularly a situation that is observed in unlisted company scenario, wherever there are investors coming from many backgrounds with different objectives, and what is known as cap table management. So investors and promoters at times wish that there must not be frequent fluctuation to the shareholding pattern, that is the capital table. So if that is the wish, uh, then the best recourse is to set up the trust and issue the shares in advance, park the shares in advance, and the ESOP trust would be appearing as the shareholder, and as and when employees would be exercising, the trust would be giving the shares back to them. But until unless there is exercise, there is a long what is called say the exercise period is long. Uh, During that, there can be a kind of stability seen in the shareholding pattern. Very significant point is another point is facilitation of cashless exercise. Very desirable point from the employees or employee community, and it is equally also desirable by the management, because every management is also they also are very much worried as to how they can make the ESOPs employee friendly. So cashless exercise is such a thing that every employee desires. And cashless exercise can happen in two modes. One is by help of empaneled brokers, where the empaneled broker uh, uh, uses its own finance and used to open myriad number of employee accounts. I'm talking about an ESOP scheme where say 1,000 employees are there, or say 500 employees are there. Then empaneled broker, we have seen that generally they open 500 accounts. I mean 500 demat account for, I mean, each employee, for each employee there is a demat account, and that demat account is opened in their own system, and the transaction happens. But that is too much complex and involves more paperwork, a very complex paperwork, as compared to the second alternative. I'm talking about the ESOP trust route. So cashless exercise through ESOP trust is really much more hassle-free, with a very reduced paperwork as compared to the first choice, first alternative through the empaneled broker. So in ESOP trust, what happens is that because ESOP trust would have already the shares, and ESOP trust sells a calculated portion of shares or all shares, if allowed under law, all shares in the market for and on behalf of employees, and whatever money relations are there, uh, retaining the exercise price, taxes, and other charges, other things are given to the either money or balance shares are given to the employees. So that is quite possible. So even though we have two choices, uh, I mean, it is a matter of comparison that empaneled broker route may be very cumbersome wherever the employee number is high. It may not be bothersome. I mean, it may not be very much worrying in case if you have implemented for handful of persons, say 5 persons, only 5 persons. So empaneled broker route may be efficacious. The next point is better controllability on movement of shares. So it is relevant in an unlisted context. So we have seen that if I talk about an unlisted company, and particularly a private company, uh, both the setups are which are known as closely held companies. So in closely held companies, the mindset is that, and rightfully also, the mindset is that the management, the owners don't feel very comfortable giving ownership or full ownership to the employees if a big liquidity event is pending, or IPO is pending, IPO is yet to happen. Their fear is genuine, and they feel that what will happen after exercising the options, that means after the employee has received the shares, will leave the employment, will leave the company. Uh, they can join a competition, they may try to sell to anybody. And as far as I mean legal ownership is concerned, also, as we know, I mean legal ownership entitles to attend the general body meetings, and a person who is having legal ownership over shares, that person used to have right to information about various things of the company. So from the comfort point of view, from a risk management point of view, particularly it happens with closely held companies that they wish that if legal ownership can be split and can be given to somebody else. So somebody else, yeah, somebody else here it means ESOP trust, because it can be very safely given to the ESOP trust. So a structure is available, which many companies have done, where at the time of exercise, so long as company remains a closely held company, unlisted company, upon exercise by employee, the ESOP trust continues to hold the shares and beneficial ownership is given to the employees, so that there is no mischief with the movement of shares. There is no fear, and there is absolutely no fear that any employee can carry those equity shares and do any mischief with that. So for better controllability on the movement of shares, ESOP trust can also play a vital role. Another point is that creation of a marketplace. Again, when we talk about a marketplace, of course, we are talking about an unlisted company. So it is relevant in unlisted context only. I'm talking about a company, a cash rich or relatively cash rich company, or a company which is having adequate cash. Uh, because we are talking about unlisted companies, so there must be some provision, or there must be provision as to giving liquidity intermittently to the employees. So some companies structure their ESOP scheme in such a way that there is a periodic buyback by the trust. It is different from buyback by the company. So buyback by the company is a quite cumbersome process. It is a very long legal process, regulatory process. I'm not talking about that. I'm talking about buyback by the trust, uh, so that some cash is infused with the trust, and trust opens up a buyback window, uh, and employees periodically give their shares to the trust, and that liquidity mechanism is happening. That is shortly known as marketplace, creation of a marketplace, and that is quite possible through an ESOP trust. Now coming to difficult situations, say for whatever reason, while structuring an ESOP scheme, we find that there is the company intends to give to a large cross section of employees. Company also wishes to freeze the shareholding pattern. Company wishes to go for cashless exercise through trust, and company also wishes to create marketplace. But the key thing is that because every ESOP trust would need some funds, whether the funds would be from internal source or from external source, but funds would be necessary. Now, if you come to the last part, inability or unwillingness to fund the ESOP trust, what will happen? So in that case, whatever is the situation, whether it is desirable situations, or say if the company wishes to go for secondary shares, but company doesn't have funds, then in that case, uh, this idea has to be done away with. It is not feasible. It doesn't seem feasible. So we have a separate slide on how to fund and whether there is a threshold on funding by the company to the trust. Uh, we have a separate content on that. But in a nutshell, I can say that if there is a problem with the company for giving any loan or funding to the trust, that may create a roadblock. Another thing is that certain sectors like a banking company is not allowed to fund a trust. So that's why I cannot say this is the sole reason, but this may be a reason that in banking sector, uh, very few companies, one or two, handful of banking companies used to have trust. Otherwise, generally banking companies never used to have trust because there is a restriction on funding. So banking company can have a trust, but they cannot fund a trust. So one or two examples are there where we have also worked, where with the help of outside financer, a banking company created a trust and their ESOP scheme is running. But generally, this is an embargo. This can stop the process. Now, to understand, even though I don't know whether most of us are well aware of how an ESOP trust works or not, but for the benefit of all, I'll just like to quickly tell in an ESOP ecosystem how the ESOP trust works. So there are four, you can say, entities or four forums. One is company, another is ESOP trust, employees, and stock exchange shareholders. So those are separate. As far as company implementing an ESOP scheme, uh, true trust is concerned, so we can see how the activities will go on. So first of all, company grants ESOPs directly to the employees. This is the process number one. Uh, so employee receives the ESOPs, and time passes by, the vesting happens, exercise is approaching, and just before exercise or during exercise, what happens? You can deem it whether during vesting or exercise, during that time, what will happen? So company needs to fund the trust so that the trust can acquire shares. So we have taken two cases. So number two, after grant of option, the second stage would definitely loan by the company to the trust. Again, I'd like to clarify that in case company doesn't have funds, but there are financiers available who can fund the trust, that can be substitution of the company loan to the ESOP trust, in which case outsider can finance. But generally, that never happens. In 90, more than 95% cases, generally the implementing company funds. That's why we have taken in this example. The loan will be coming from the company to the trust. And the third process is that the trust will, soon after getting the loan, trust will proceed to acquire the shares. So there are, in the third uh, arrow, third activity, we have two things, either or it can be both as well, because there are certain companies which have a mix of primary shares and secondary shares. It can be both as well. So in case of primary shares, trust pays the subscription money, the entire loan money is given back to the company, and company allots the shares. So in a primary shares case, the key principle here, you can see loan is always cash flow neutral. The money which has come from the company goes back to the company again. If you see what happens uh, on the counter side, in case we are going with the secondary shares, whatever loan amount has come, that will be given to the market. That means a stock exchange in case of a listed company, and in case of unlisted company, to the shareholders. And in case of gift, of course, I mean, that may not need any kind of loan. But in general, I mean, if I'm talking about secondary shares in unlisted context, generally those are bought from the current shareholders, existing shareholders. So it impacts the cash flow. It is a real cash outflow, and trust pays the purchase price and acquires shares from the market. Now, again, the time passes by, the exercise time comes. So again, there are two choices available. As far as exercise is concerned, the fourth activity, either it can be cash exercise or it can be cashless exercise. So in case it is cash exercise, employee pays to the trust, the exercise price is paid, and tax is paid to the company directly, because company as an employer, company has to take care of the TDS, tax withholding, and the trust transfers the shares to the employee. So this part is over with the cash exercise. As far as cashless exercise is concerned, it was one of the points which we discussed, that when companies should consider having an ESOP trust, particularly when there are many employees, or particularly, even I have not said, which is again a very important point, is that in case you have foreign employees, or say you have blue collar workers, it is really helpful if you can facilitate cashless exercise for them. So trust is a kind of unavoidable situation in those situations, in those scenarios. So in cashless exercise, trust sells the assets in the open market and retains the exercise price, taxes and charges, and transfers balance sheets or money. So there are two types of cashless exercise where uh, I mean, at the end of the transaction, either there shall be balance sheets or there shall be balance money. In case it is balance sheets, trust transfer the assets to the demat account of the employees, and in case it is balance money, the money is remitted to the bank account. But in cashless, uh, uh, as a principal, employee is not required to pay anything. Employee is just required to give an instruction, an instruction, email instruction or electronic or whatever paper instruction, uh, uh, authorizing the trust to do the cashless. Here is a caution. I made a note here that in a listed context, cashless exercise of ESOPs on sell-all basis is not allowed. So SEBI has recently changed this. So while going through or thinking about cashless, we should always keep in mind that in case of a listed company, for normal ESOPs, sell-all is not permitted as of now. SEBI may change this afterwards, but currently it is not allowed. The only exception is that in case of SIR scheme, cashless on sell-all basis is allowed. I mean, in SIR scheme, if employees wish to get money only, they don't need shares. They can instruct the ESOP trust to sell everything and give them money. That is possible in SIR. But for unlisted companies, that's why I have not written. Unlisted companies, everything is possible. Now coming to the very key aspects, we will identify, we will examine the very DNA and very outer body of the ESOP trust. If you know these properties, the very characteristics of ESOP trust, we can know it very well. So from the setting of uh, setting of aspect, the first question is that who sets up the ESOP trust? Generally, the ESOP implementing company sets it up as the settler of the trust. Settler means the creator of the trust. There may be question that if a promoter, whether the promoter created trust can act as an ESOP trust or not. So in unlisted context, because there is no guidance or clear guidance in this regard, that may be all right, but for listed companies, the implementing company must create the trust. Promoter cannot create the trust in listed context. The next question is that who are the parties to an ESOP trust? So when we talk about any trust, including an ESOP trust, there are necessarily three parties, and probably there cannot be a fourth party. The three parties are always settler, means the creator company, who is the implementing company, who creates the trust, who writes the trust. Trustees are the second persons who the persons who are eligible under law are generally appointed by the settler at the time of creation of the trust, and those persons are called trustees. Those are the administrators of the trust who really govern the trust. And the third persons are called beneficiaries, for whose benefit the trust is made. So essentially, these are the three parties in an ESOP trust. And the beneficiaries are never named because nobody knows who shall be the beneficiaries or who are the beneficiaries. Currently, if we know that Mr. A, B, C are beneficiary, but future we don't know who shall be the beneficiaries. So in a trust deed, beneficiaries names are never written. So there is a generic definition that personnel eligible for ESOPs are the beneficiaries. And law requires that whenever we talk about an ESOP trust, the ESOP trust is very much beneficiary centric. It must be helpful for the beneficiaries. Whether any prior approval is required from any statutory authority or registration is required, no prior approval is required from any authority. Registration is also not mandatory. Otherwise also, I mean, few companies go for registration, but registration never gives any special privilege. However, some companies feel that registration may add to their governance practice, that is a different question. So if a company feels that they can register, they should register, they can, I mean, that is doable. But there is no good or bad thing relating to registration because it is not mandatory. Sometimes it creates problem. Sometimes from governance point of view, it may be considered a bit positive thing. Who can fund the trust? Funds or loans can be from any person. So law has not put an embargo that only company will fund the trust. It can be really from any person who can or who intends to give any finance to the trust. It can be promoter, it can be investor, it can be any bank or NBFC, whosoever. But practically speaking, as I stated earlier as well, that more than 90-95% cases, generally it is funded by implementing company. So as we know also that nowadays even employees of group companies or subsidiary companies also participate. Generally, if that is the case, if those companies used to have funds, generally some part of fund is also met by such other companies whose employees are have been selected to participate. Now coming to the next point, eligibility for being a trustee. So there are two situations. The first situation is that if funded by the company, what shall be the rule? If not funded by the company, what shall be the rule? So if funded by the company, for a listed company, we have three categories of companies we have created for this reason. Any person means any person competent to contract, any person being either being a corporate trustee or a natural individual, except these persons. Those means I'm talking about the list, I mean negative list. In the negative list, promoter, director, KMP of the company, of its holding company, subsidiary, associate, group company, or their relatives. And the person holding 10% is more of the paid up capital or voting rights in the company are in negative list. These persons cannot be a trustee in a listed company environment. The same is the thing with unlisted company, unlisted public company environment. The only exception is that the group word here is missing. That's why we have stated. So in this case, in case of unlisted public companies, ESOP Trust, promoter, director, KMP of the group of its group company can be a trustee. That is an exception though, but these are looking alike, almost alike. And for private company, there is no restriction. Even promoters or one of the promoter investor can also be a trustee. And this is particularly possible when loan is covered under a different section, because in the Companies Act, we'll discuss that aspect. There are two sections under which loan can be given to an ESOP trust. One is section 67. 67 mandatorily covers listed companies and unlisted public companies. And there is another section which is a very generic section for which entitles a company to give any loan, section 186. If loan is given under 186, even a promoter can be a trustee. If not funded by the company, what will happen? So for a listed company, the same restriction applies. It is indifferent whether funded by the company or not. For a listed company, always this negative list will be there. But for unlisted public company, there is no restriction. Even promoter can be a trustee. Private company we discussed, again, there is no restriction. Next question is minimum or maximum number of trustees. What is the guideline for that? Listed companies, SEBI very clearly directly states that there shall be minimum of, in case of natural individuals, 2 such persons, and in case of a corporate person, what we know is a corporate trustee, only 1 corporate trustee can do. For unlisted company, there is no guideline at all. So in the absence of any specific rule or guideline, as a best practice, generally the aforesaid principle is followed: 2 natural individuals or 1 corporate person. That is called the corporate trustee. Ceiling in case of company loan guarantee security, again, we have come up with the same 3 categories of companies which we discussed in the earlier slide: a listed company case, unlisted public company, and private company. For listed company, it is very clearly stated that 5% of the paid up capital free reserves as per the latest audited balance sheet available, of course, as on date of introducing the scheme. The very same is the case with unlisted public companies. So both are same. As far as private company is concerned, there is no ceiling when the loan is covered under section other than 67, because section 67 is a ESOP financing. Roughly speaking, we can understand section 67 as a section which authorizes to uh, particularly finance the ESOP trust. So if a private company funds under a general loan section, not under the ESOP financing section, then of course, I mean, no restriction applies. It can be anything. Say anything means that is the generic limitation is 50% of the paid up capital and free reserves. This 5% becomes 50% in case of a private company. Rate of interest, the next question is that if loan is given, the very pertinent point is that what is the guidance on whether it should be interest bearing or it should be interest free. So in case of loan under section 67, as we know, these two companies are bound to be under section 67. There is no choice. So under 67, uh, choice is available to the companies, because 67 has not specified whether it is interest-free loan or no interest-free loan. That's why in the public domain also, if you scan 100 listed companies case, you will find that more than 70% or 75% companies opted for interest-free loan to the ESOP trust. So both are possible. So that's why there is a choice available. But in case of a private company, because here we are concerned about, in case of a private company which is not given a loan under ESOP financing, that is 67, then in that case it should be at arm's length. That is at the market rate. Market rate means say SBI rate, or that guideline has been given normally at 9 or 10%, whatever market rate is calculated. ESOP trust is required to maintain books of accounts and registers, and there is no exhaustive list as to what kind of exact books and registers should be maintained, but the law requires that all books, ledgers, minutes, books are required to maintain, so could vouch for its true and fair state of affairs. As far as a consolidation of account and audit are concerned, under Ind AS 110, trust accounts are consolidated with that of the settler company. But in case we talk about a company to which Ind AS is not applicable at all, so consolidation is not compulsory. I mean, the trust accounts are kept separate from the company, but because majority were seeing application of Ind AS, so generically we have provided this is applicable to majority. So it is consolidated with the company account. And as far as audit is concerned, annual or quarterly audit is not mandatory. However, it is the best practice to do so, and depends on the opinion of the auditor of the settler company. So particularly this quarterly audit is relevant for listed companies. And we have seen that many listed companies auditors used to prefer audit of the trust accounts annual also. I mean, on annual basis also audit is preferred, because the view is that if companies accounts are audited, why not the trust account should be audited, because after all, at the end of the day, both are consolidated. So there are high chances that this audit must happen, even though legally it is not mandatory. As far as taxation is concerned, trust is required to file its income tax return, particularly in the year if it has any taxable income. And there may be a myth that whether ESOP trust's income is taxable or not. Some persons might have, I mean, from hearsay information or so, you might have heard, or some might have some conception that ESOP trust income is exempt. It is not true. ESOP trust income is taxable like a normal person. Generally, it is taxed like an association of person. And so here in this context, we can see, because ESOP trust is not supposed to do any business, it is not supposed to do any trading business, etc. So what kind of incomes are likely to accrue to the trust is generally capital gains. In case trust acquires shares at 50 rupees, but the exercise price is 60, that means trust is transferring at 60 rupees by gaining 10 rupees. So that is called the capital gain of 10 rupees. So that can be an eventual income, even though that is not calculated, that is not by design that happens, but sometimes that happens. Eventually that income happens. And dividend income is also a natural income. If during the period of holding, if company declares dividend, so trust as a legal owner gets the dividend. So these are the two popular kind of maximum 95% of the income, taxable income, uh, comprises of these two, uh, capital gains and dividend, and both are taxable. Now coming to certain presumptive queries, even though we have time just for queries, but we have got many queries from as we started at the very as we started this session. At the very beginning, I stated that we used to get many queries from companies at various stages of ESOP implementation. So why not to discuss those? And I will just go through these queries and our brief answers. And apart from that, if you have any questions relating to these queries or relating to the content of this presentation, you are welcome. So the question is, when should an ESOP trust acquire shares? So if at all it is decided that a company should have an ESOP trust, is okay. Now the question is, when should an ESOP trust acquire shares? Whether it is prior to, at, or post grant, or it is prior to, at, or post vesting or exercise. This is a very frequently asked question. As far as this question is concerned, we can have a kind of disciplined approach. The 90% of the answer remains in the structure of the ESOP scheme. Particularly if I'm talking about, say, an unlisted company, where unlisted company states that the shares, the exercise is allowed only during or in connection with a liquidity event. And liquidity, if the company knows that liquidity event is far away, say 3-4 years away down the line, so it is not required to issue the shares uh, today at the time of grant or even prior to grant. Not required, because that would need some funding requirement as well. So that can be postponed. Another structure of the ESOP scheme, I'm just giving, there are many structures. I said that the structure of the ESOP scheme will give 90% of the answer to this question. Another question is that uh, if if an ESOP scheme is what is known as plain vanilla ESOP scheme, and it allows, say, immediately after vesting at any point in time, say within the next 2 years or 5 years, employee can exercise the options. That means at any time prior to vesting, the company must be uh, company must make the trust ready with the ESOP shares. That means prior to vesting, calculated number of shares must be placed with the trust, so that post vesting employees should not face any problem. They can straight away exercise and get the shares. If that is a that much simple scheme, then prior to vesting. And in case I'm talking about a listed company, where the listed company acquired shares from the secondary market, and will hold these shares for or up to the time of exercise. The problem here is that in a listed context, if the price is volatile or otherwise also, because from the date of grant to date of exercise could be a journey of 2-3 years, and during that time anything can happen. The share price may even be double or triple from today's price. So it is ideal that very close to the date of grant, in case a listed company goes for secondary shares acquisition, within couple of days, the attempt must be made to get the shares from the market so that the difference from the market price as on date of grant and the market price as on date of acquisition should be minimal. Difference should not be that much huge. In which case, it may result in uh, either eventual income or taxable income or eventual loss in the hands of the trust. And the principle of ESOP trust is that whenever a loan has been given or general books of account maintenance is done, the transaction is structured in such a way that the trust should square off everything at the end of the day. When the transaction ends, everything should be squared off, or in case there are chances of any eventual income or loss, that should be minimal. So from that point of view, it should be seen that if there are chances of the share price going up, particularly in case of secondary shares acquisition, the attempt should be made to quickly gather the shares, so that there must not be any chance given to, to create a huge difference, huge delta. Whether an ESOP trust selling shares under a cashless mechanism, and this is a very frequently, I cannot say, I mean, there may not be any basis to it, but there has been a great apprehension about this issue, but this is not the real issue in our view. Whether an ESOP trust selling shares under a cashless mechanism, whether sell all or sell to cover shares, I mean, a part of the shares are sold for and on behalf of employees, invites tax liabilities for itself. I'd like to give you a quick example that the share has, I mean, the ESOP trust has acquired shares at 50 rupees when the market price was, say, 50 rupees. And the exercise price was also 50 rupees for the employees. Now, after, say, 3 years, the price has moved to 200. Employee has today wished to exercise on cashless exercise basis, so that the trust is moving to the market with one share because that one share's worth is 200 today. Now trust will sell the shares at 200, for which the cost of acquisition is written as 50 rupees. Now actually the trust is selling at 200, so that the trust will retain 50 rupees towards the exercise price and pay 150 rupees, say gross proceed to the employee. Now there have been apprehensions in certain counters, certain cross section of companies, that whether this 150 rupees would be taxable in the hands of the trust first, and then again taxable in the hands of the employee when the trust would be giving that money to the employee. To that we are saying this has never happened. This trust related transactions have been happening since more than a decade, and companies have been doing this kind of cashless exercise through trust route since many years. And that 150 rupees which the trust gathers from the market, that I mean, by selling the shares for and on behalf of the employee, so 150 rupees taxable gain that belongs to the employees, for which the employee himself itself is taxable. It is not the trust. So there is no trust personal liability for taxation whenever the trust does any work for and on behalf of employees. And by the way, this trust cashless help or assistance is not something any consultant has just devised, or it is an articulation by any consultant or any strategist, but it is given by the regulation itself, because the regulation has itself given this liberty or this facilitation that an ESOP trust can help an employee for cashless exercise, where selling for and on behalf of employees is a must. That's why there is no personal liability for the trust. So trust can keep on doing the transaction, for which all tax liabilities shall be borne by the employee, not by the trust. However, if the trust is gaining some profit for itself, for which it is not required to pay to the employees, of course, trust is liable. We have not talked about that. Any personal gain of the trust would be taxable. Whether transfer of shares by promoter investor at lesser than FMB, say gifting of shares, brings in taxation for the both. So this is also a very frequently happening situation nowadays. Particularly, even this happened with listed entities as well, not only unlisted but also listed. But this is frequently happening in unlisted context, particularly whenever investors negotiate with promoters or other investors, whenever they wish that a new investor is not willing to dilute, the negotiation happens in such a way that other investors or promoters would be parting with their shares by donating or by transferring their shares at a negotiated price to the trust. So now the question comes, at the time of such transaction, whether for example, we can take a gift, because SEBI also allows gifting of shares. Uh, so whether promoter gifting shares to the trust, gifting means zero price. So whether that will uh, invite any adverse taxation for the promoter or gifting promoter and the ESOP trust? The answer is yes. Unfortunately, I mean, there is no clarity, or the way the new section which has come in the Income Tax Act since last 3 to 4 years, it states that if any person is giving any equity or donate, I mean, transferring any equity below fair market value, the person who is selling or who is transferring, that is the promoter in this case, that person would be subject to uh, taxation under the deemed capital gains tax to that to the extent of the shortfall. On the other hand, the person who is receiving, here in this case an ESOP trust, would also be taxable under the head income from other sources. So this apprehension is true. This really lies. Uh, because it is a relatively new section, so there are no much tax precedents available, but these are all, I mean, happening, or this is at opinion level, I can say. These are all opinions, but no so much of cases have come on this. But this is a real apprehension. Whether issue of shares by company below fair market value of shares results in any adverse tax impact, of course, for the company and of course for the ESOP trust. So here we discussed about transfer of shares by the promoter, investor, etc. That is any other person to the ESOP trust. Here the case is a bit different when company issues shares below fair market value. Whether it results in any adverse tax impact, the answer is no, because whatever income tax sections we discussed here in point number 3, those are relating to transfer of shares. So for issue of shares, there has been no section in the Income Tax Act, and this is totally, there must not be any apprehension on this. And our firm view is that there is no tax adverse impact in case company issues below fair market value. And this has never happened uh, since since the time we know ESOPs. And currently also, I mean, the position is same. Whether adoption of trust route gives any special ESOP tax advantage to the employees? No, because ESOP, adoption of ESOP trust maybe is, I mean, maybe for facilitating something which the company cannot do, or for facilitating some administrative convenience. But having a trust route or not having is totally indifferent to the tax advantage for the employees. Employees are not going to get any tax advantage. I mean, not the disadvantage as well. It is indifferent for the employee's tax liability. The case is same if we draw an Excel sheet with trust route, without trust route, given the same, valuation going on for next 4 to 5 years, we will find that employees' taxation is absolutely same in both the cases. Trust is acting merely as a platform for holding and for doing transaction for and on behalf of employees, but it has no linkage with the employee taxation. Question number 6 is kind of similar, whether adoption of a trust route gives any ESOP cost advantage to the company. So as far as ESOP cost advantage or ESOP accounting cost is concerned, trust route has nothing to do with the ESOP accounting cost. I'm talking about, say, the new accounting standard. So having an ESOP trust or not, again, it is indifferent to the ESOP accounting cost only. It is not shares accounting. I'm referring to ESOP cost, ESOP accounting. So it is indifferent having a trust route or not. Seventh is whether share premium account. This is a recent question, and this question may gain importance in the time to come because we are in startup ecosystem where we used to see that startup companies used to have in the reserves 95% of content from the share premium account because they used to heavily dependent on issue of shares, investment coming in. So in the reserves, if we analyze the reserves, we can find enough share premium amount there, whereas the retained earnings or the yearly profits are not there, particularly talking about consistently loss-making companies. So if that kind of company is going forward for ESOP implementation, now the question comes, there is a threshold for companies loan to be given by that company to the, uh, to the ESOP trust, that 5% of paid up capital free reserves, whether this share premium amount in this free reserve, say if it contains say free reserve, whether this amount is considered. If it is considered, the answer would be that a startup company can give up to 5% because that amount would be adequate. If share premium amount is not considered in this, uh, you know, in this phrase, of course, many companies would be debarred. But in any case, we stated that as far as private companies are concerned, this 5% may not apply because they can go for general loan instead of going under section 67. They can go under section 186 under the general, general power of the board to give loan to any entities, including the ESOP trust. And under that, this 5% will go away. So they will not face any problem. Otherwise, we have come across with a typical case, a startup kind of company into technology, internet-based company. And unfortunately, that is an unlisted public company. So Section 67 applied, and this 5% is also applied. And unfortunately, the free reserve doesn't contain the share premium account. So there, this phrase, paid up capital free reserve, is a very inadequate amount. And only for this, because they could not consider share premium amount, they could not give a loan to their ESOP trust. And that was a showstopper. We can take up any questions.
Yeah, hi Umar. Thank you for that session. It was really helpful. I'm sure many queries would have been answered. There were many questions in our chat box. While I have tried to answer most of them, I would place some in front of you
Yeah, yeah,
to receive your, feedback while, in terms of the legality of it. Uma, I mean, the first question, first set of questions that I would put forward is if you could just summarize, when should a company look for a trust as an option? I mean, if you can just summarize, I mean, there is some confusion whether there some attendees have asked whether I should look. I'm not still clear. So if you can just
Mhm.
summarize when to look at a trust, I mean, the 3 points on your screen you
Yeah,
have
got
shared,
it.
right? And
Yeah, I
along
got
with
it.
that, who has to be a settler of this trust? Is it compulsorily the company, or as you were talking about the bank doing a trust, right, through
Yeah,
investor case? Yeah. So if
I'm
that
coming to
can be
that.
the first question, and I'll just mute myself for you to answer it.
Uh, when to implement, when to adopt an ESOP trust or not, as I said, that the first and foremost thing to be seen is what is the source of shares. If the source of shares is secondary or a mix of secondary, because there are cases out of 5% is kept as reserve for ESOP implementation. Some companies wish that 2% can be procured from the direct issue by the company, 3% from the investors or from the promoters. That means if there is even a single share, single secondary share or any secondary share is contemplated, you have to go through an ESOP trust route. There is no second thought on that. So that will give you some direction in which direction you have to move. But in case if you find that you are contemplating totally primary sets, that means you have the choice of having or not having an ESOP trust. You have that choice. Then you have to consider whether you have other cases, like what is your employee coverage, whether your employees are supposed to come to you very frequently, whether you can have a permanent, because practically speaking, no board sits in the company every day or every 3 days. Board meetings used to happen as and when required, or once in every quarter, like that. So if you are allowing exercise every day or every 3 days or 4 days, it is not practical for your board or committee to approve the allotment. You have to see what is your case. Another case is that whenever you are closing to your exercise, say you are an unlisted company, you are close to exercise, and you know that people are really wishing for cashless exercise. Even you talk to empaneled broker, and empaneled broker has given a solution that seems very bothersome, very worrying to you. You have to consider having an ESOP trust so that the cashless exercise can go really hassle free.
Okay,
First
Uma.
and foremost, I said, I mean, source of share is the vital thing that gives you
Hmm.
direction, east or west. East or
Okay.
west. So that is the thing. Your next question was,
Who has to be the settler for this
yeah,
ESOP
I'm coming
trust?
to that.
Yeah.
For answering this, we have to see what kind of company we are. If I'm a listed company, SEBI has very clearly stated that in case of secondary shares, or say whenever a trust has to be set up, that should be set up by the implementing company. Funding can be given by any other company. So this is for the listed company. Implementing company must set up the trust. Because there is absence of this kind of guidelines for unlisted companies, we can have leeway. So using that leeway, I can say that for an unlisted company, even though the best course of action is to follow SEBI always. Why? Because that is never questionable if we follow SEBI. Because there is no rule, we can follow SEBI. That is a good defense always. But for whatever reason, if a company says us that that is impossible for them, company for whatever XYZ reasons, company cannot settle the trust, then if we can examine, and it seems feasible that even a promoter can also settle the ESOP trust. It is not a no from the law point of view. It is okay. But as I said, you best course of action is to follow SEBI. That means implementing companies should uh, set up that trust.
Okay, Uma. That is very helpful. Thank you for that. Uma, there was one more question, and this gentleman is seeking clarity in terms of the consolidation of the trust accounts with the company's account. So, there are options to consolidate the ESOP trust with consolidated, unconsolidated financials of the company. Auditors do have a say on this, right? How do auditors look at the accounts of the trust? So, if you can throw some light on that, I mean, it would really help the audience.
Yeah, I mean, briefly, I can say not much technicalities into how that item-wise consolidation happens, but generally, I mean, consolidation happens, and that too, item-wise consolidation happens. And this consolidation is pursuant to Ind AS 110. Uh, and under that consolidation, I mean, shares are shown as if not issued. I mean, if shares are issued by the company, say the total paid up share capital is 100, and the company issued say extra 10 shares to the, I mean, 100 is the paid up capital, 100 shares, and later on the company issued 10 shares to the trust. So in total now it is 110. So after consolidation, it shall be shown as if the company has 100 shares. The 10 shares would be adjusted, because that 10 shares are within the periphery of the company, because that is never issued to an outsider. That is still within the ESOP trust, that is within the periphery boundary of the company. So these kind of adjustments are being done in the consolidation. But going to the technicalities, because I don't think that there shall be enough questions, because there is a clear guideline as to how consolidation will happen. Um, And I don't think that there are much rooms for interpretation in that. The standard is so clear, and consolidation we have been seeing since application of Ind AS on many companies since last 4 to 5 years. We have not seen any kind of complication in this, and we can guide if any further technicalities are required. We can contact one-to-one offline.
Sure. Thank you, Uma. Another question is, once the company, if company has an ESOP trust and they have implemented the scheme through a trust, but going forward, they do not want to utilize the trust and there are some equity shares parked in the trust. So there are two sets of question around this. One is what happens, what can the company do about it, which I feel the trust deed will have to mention if it is not mentioned. Secondly, again, if the company, if the scheme is wounded up, there are shares which are sold in the market by the company. What has to be done with the monies collected through the such sale? So more on the, dissolution of the trust. What happens to the assets of the trust?
Yeah, dissolution of the trust, I mean, for two reasons. I can say that if a company has an ESOP scheme and an ESOP trust, both are there. But for whatever reason, company may wish to liquidate the ESOP trust and carry on with the ESOP scheme. That could be one case. Another case would be that company may like to liquidate both the things, ESOP scheme as well as ESOP trust. So when ESOP scheme as well as ESOP trust would be liquidated, that would be a very easy case. I'll come to that, but first let me clarify on the first case. If the scheme will be continued, but trust would be dissolved with the thought that after dissolution of the trust, the scheme shall be a direct route scheme. Trust route is no longer required. So the first step for dissolution of the trust is that all the outstanding liabilities must be met. Maybe by selling the shares, it is easy to sell the shares. But in case of primary shares, it shall be difficult. In case of secondary shares, SEBI has clearly stated that if a company has outstanding loans, even secondary shares can be sold and outstanding liabilities can be met. Rest of the monies, the residual money. Now the question is, what will happen to the residual money? If the trust deed is irrevocable, it is stated that generally trust deed used to state what will happen to residual money in case of dissolution, and company has to follow the same route, and that will give direction to the company. There must not be any ambiguity. Generally, it happens that the residual money is expended, reserved for another employee benefit scheme or general welfare activities. Also it can be used like employee children's scholarship, any sabbatical program, any educational program, any lunch scheme, anything. If it is irrevocable, that money should not come back to the company but must be used for employee specific reasons. In second case, if everything is liquidated, again the question comes, if that is an irrevocable trust, again that same principle will work. Residual money will not come. Here I'm meaning residual money means if a company has given 30 crores of loan and if the trust has 45 crores of worth of shares, of course the company can get the loan repaid by the trust. So 45 crore of shares shall be sold in the market. Company will take 30 crores of loan because that is an outstanding loan liability for the trust. So company will get it. But residual money, I'm talking about the residual thing. If it is stated that residual would be used for employee welfare, that must be used for employee welfare. And we don't think that using any amount for employee welfare would be harming the company in any way, because company's expense to that extent can be reduced. If company is expending for employee welfare, company is no more required to expend for that because trust is incurring. So it is complementary, supplementary, even though the money will not come back to the company.
Okay, Uma. So one, there's one situation which has been given, and I think it's a beautiful situation to summarize the presentation also. So if there is a regular ESOP scheme that was implemented by the company and the company is now bringing in an ESOP trust, typically how would it be implemented? Whether the invested pool for ESOP scheme should be transferred and allotment should happen for ESOP trust, or how, I mean, typically how would the shares come to the trust once, because the options have already been granted, and so that some light over there. So the scheme is there, options have been granted. Now company goes for a trust. So how would the trust acquire those shares? Whether it will acquire the entire invested pool, or invested outstanding options as we call it.
Okay, so these are two things you said. One, you said options. Okay, options are separate. So options, trust has no role. We should understand that option is an instrument that generally flows from company to employee and vice versa as well. If employees wishes to surrender the options, options directly come to the company. Trust is a place always to hold the shares. It has nothing to do with options. So keeping in mind this principle, we will see that there is an ecosystem already existing where company has already granted options. Time has yet not come for dealing in shares. Now there is a thought that in your ecosystem, in your given case, you had said that say 100 out of 100 options, say 30 has been vested, 70 are unvested, those are yet to vest. What will happen in case the company wishes to incorporate a trust system? So here in this case, a trust can be inbuilt in the system by introducing the trust, where the trust will contemplate 100 equity shares, and the trust role shall be to hold for stated period of time and to dispose of the shares as per predefined rules in the scheme or as instructed by the board from time to time. If it is wished that shares should be parked right now, it can be issued to the trust right now. If it is stated that trust has to hold until liquidity event, trust will keep on holding this. If it is stated in the scheme or already stated in the scheme that whatever number of shares, I mean, the company will help or say trust will help. So in that regard, I mean, there shall be little bit of amendment in the ESOP scheme, and trust will continue to do as intended. If it is stated that during the liquidity event, the trust will help the employees in cashless exercise facility, trust will continue to do that using its own shares, because shares, if you see from spirit point of view, those shares actually belong to employees, but it is for the time being trust is holding for helping in this whole process. So it is not difficult at all. So irrespective of whatever is the XY proportion you said, XY proportion of vested and unvested, it could be MN, it could be any proportion. Irrespective of that, trust can always be infused into the system. But care must be taken that while infusing, while incorporating a trust, we should not try to take out any right of the employees. In any way, we should not draft any provision while bringing a trust, while inviting a trust into the system. That will take away the rights, or that will unnecessarily cause any kind of say undue hardship on the employees. That should be avoided.
Okay. Uma, one last question, to top up the dissolution of the trust. Can the residual money be parked in a separate bank account of the company and can be used for employee welfare at a later stage after proper planning? After parking the money in a separate bank account, can the trust be dissolved? Who shall be the signatories for that separate bank account if it is permissible?
Yeah, it is permissible. Here, what I mean, from the unlisted point of view, there is no guideline. But from listed point of view, there is a clear guideline, but there is no guideline as to Mr. I mean, what kind of what is called signatories
Signatory.
from the signatories from the company. What level of personnel from the company should be signatories to that escrow account or any other bank account, etc. That is purely an administrative matter. In our view, we should rather focus on what is called the spirit of law. As we know, the spirit of law is that in case of irrevocable trust, the residual money should not be taken back by the company for its own business purpose, but must be used for employee welfare, maybe today or maybe later point in time whenever company feels that it is the appropriate time to expend this money. So who shall be signatories and what shall be the period, etc., would not carry much meaning, but everything must be done in a bona fide manner. If the arrangement has been done that reflects that company has done in good faith, that is enough.
Okay. Uma, I think we have overshot. We are exactly at
Yeah,
5:30,
okay.
what we had
Yeah.
envisaged. Thank you for the session. It was really insightful for everyone, including the internal team as well. To all the audience, thank you for joining this webinar. I am sure there would be some knowledge enrichment for everyone here. I tried to cover most of the queries, maybe in a summary form, but apologies if I have missed anything. I'll be more than happy to connect with you on a call and take this forward in case there are any queries. You can write to us and we can schedule a call for this. Thank you once again, and we'll be continuing this series of webinars at a monthly basis or a fortnightly basis because this is still an uncharted territory. It's a deep niche that we are talking about, and we can explore it together. So thank you, everyone. Thank you, Uma, for
Yeah,
your
thank
time.
you, everybody, for your time.